Hello and welcome to the Indian Insight channel. Today we are diving deep into two of the most powerful and widely recognized chart patterns in technical analysis, the double top and double bottom patterns. Whether you are a beginner or an experienced trader, understanding these patterns can significantly enhance your trading. So let's get started. First, let's break down what these patterns are and why they are important. A double top is a reversal pattern that forms after an extended upward trend. It's characterized by two consecutive peaks at approximately the same level, with a trough in between. These peaks are also referred to as tops. This pattern signifies that the bullish momentum is waning and a bearish reversal is on the horizon. Conversely, a double bottom forms after a prolonged downward trend. It features two consecutive troughs with a peak in middle. This pattern indicates a weakening of bearish momentum and suggests an upcoming bullish reversal. Both patterns signal potential shifts in market sentiment, making them invaluable for traders looking to enter or exit positions at the most opportune moment. Now, how do we spot these patterns? Let's go through the key characteristics to look out by looking at real life examples. We will look at the pound sterling chart to identify the double top pattern. The first requirement is that of a strong uptrend, which as you can see is the case here. Then we have to look for two peaks or tops that are nearly around the same level. These peaks should be separated by a trough. The low of this trough defines something called the neckline, which denotes an important support level for prices. A break below this neckline is often used as confirmation, as we will see later in this video. Next, we will look at a chart of an Indian stock, the Glenmark Life Sciences, to identify double bottoms. The first requirement for this setup is that it should come after a strong downtrend, and we see a strong downtrend in action here. Then we identify two bottoms or troughs that are almost at the same level with a peak in between that defines the neckline. This peak denotes an important resistance level for prices. A break above the neckline confirms the pattern. Now let's talk about how to trade these patterns effectively. There are multiple ways to trade these patterns. Let's understand them. The key to trading any pattern profitably is to look for confirmation before taking any action. In case of these patterns, what we can do is either use volume or an indicator like RSI, or one may wait for breakout of key support or resistance levels before initiating any trade. Depending on your trading style and comfort level, you can choose either of these ways for confirmation before initiating a trade. The most conservative way to confirm these patterns is to wait for the break of neckline. In case of double tops, the neckline is the support level, and once prices break below this level, one can initiate a short position. The stop loss can be placed above a swing high above this neckline. The target price is calculated by measuring the height of the formation from the neckline to the peaks and subtracting this height from the neckline price to arrive at the target price. It's important to take into account the potential reward and potential risk before initiating the trade. If the reward to risk is not favorable, it's best to not initiate a trade. If we wait for break of neckline before initiating the trade, we tend to miss out benefiting from the move that happens before this neckline. To address this, aggressive traders may use volume or RSI divergence to initiate a trade after two peaks are formed. It's often seen that the volume at the second peak is lower than the volume at the first peak. This indicates that the buying is exhausted and we may see a sharp reversal. Alternatively, if one is using RSI, then the RSI around the second peak should be below the RSI level formed at the first peak, as this would also indicate buying exhaustion. One can initiate a trade a couple of candles after the second peak, assuming that the prices stay below the second peak. The stop loss can be placed just above the second peak's price, while the target is determined by calculating the distance between the second peak and the neckline price level and subtracting this distance from the neckline price level. Again, it's important to calculate the reward to risk ratio and only take a trade if you find that the reward to risk ratio is favorable. I prefer to avoid trades with a reward to risk of less than 2. Now let's look at how to trade double bottoms. In case of double bottoms, the neckline is the resistance level, and once the prices break above this level, one can initiate a long position. The stop loss can be placed below a swing low below this neckline. The target price is calculated by measuring the height of the formation from the neckline to the bottom and adding this height to the neckline price in order to arrive at the target price. In this case too, aggressive traders may use volume or RSI divergence to initiate a trade after two troughs are formed. It's often seen that the volume at the second bottom is lower than the volume at the first bottom. This indicates that the selling is exhausted and we may see a sharp reversal. Also, if one is using RSI, then the RSI level around the second bottom should be higher than the RSI level formed at the first bottom, as this divergence would indicate selling exhaustion. One can initiate a trade a few candles after the second bottom is formed, assuming that the prices manage to stay above the second bottom. The stop loss can be placed just below the second bottom price. The target is determined by calculating the distance between the second bottom and the neckline price level and adding this value to the neckline price level to arrive at our target price. Again, it's important to calculate the reward to risk ratio and only take a trade if you find that the reward to risk ratio is favorable. I prefer to avoid trades with a reward to risk ratio of less than 2. Before we wrap up, here are some tips to enhance your trading with these patterns. Tip number 1, patience is key. Wait for full pattern formation and confirmation before entering a trade. Use other indicators for confirmation if you like, such as the RSI or volume, as this can increase the reliability of buy or sell signals. Practice risk management. Never risk more than a small percentage of your trading capital on a single trade, and also remember calculating the reward to risk before initiating any trade. And there you have it, guys. You are now equipped with knowledge to identify and trade the double top and double bottom patterns. Remember, successful trading is about consistent practice and risk management. I recommend that you test these strategies and refine them to suit your trading style. If you found this video helpful, don't forget to like, share, and subscribe for more trading insights. Drop a comment below if you have any questions or if there is a specific topic you would like us to cover next. Happy trading!